Thank you for tuning in. Our next presenter is Karim Nanji, CEO of Marble Financial. Mr. Nanji, you may begin.
Thank you very much. Hello, everybody. Thanks for joining. I'll get right into the presentation. Just give people some advance notice that there's some forward-looking information in what we're going to be discussing today, and I'll hop right into the presentation. And thanks for listening. Marble Financial is a fintech, a data science company. We focus in the area of digital financial inclusion. We provide unique and innovative solutions to individuals who are looking to get more education and some more insight with respect to their financial fitness and financial wellness. Here's a brief snapshot of our management team. I can get back to this a little bit later, but I'll just hop into the meat of the presentation as well. We are a public company. We went IPO in March of 2019. I'll pause on this slide for a second to give everybody a chance to review, and then I can come back to this slide towards the end of the presentation during the Q&A. So when you speak about financial inclusion, what does it mean? Digital obviously speaks to our core competency in the areas of technology and data science, and financial inclusion is a global phenomenon. It is a concept that refers to segments of population that are marginalized from mainstream financial services for various reasons. Again, this phenomenon is not specific to Canada. Our focus right now for the first part of the year is in Canada, and we have plans to expand south of the border in the second half of 2019. But financial inclusion, especially prior to COVID, where 1/3 of Canadians were on the outside looking in. By that, it means that they could not walk into a mainstream bank or financial institution and obtain credit. Now, in the backdrop of all of this, just under 50% of Canadians are living paycheck to paycheck, and this, again, is before COVID. And for every dollar of disposable income in Canada, there was almost $1.75 of debt. So we are very much a credit economy. Canadians need to borrow. But what happens to these individuals who can't walk in to a financial institution and obtain credit? The credit score and credit wellness of the individual is a big component of whether an individual can obtain credit, given the fact that credit is necessary in our economy. And there's two main components to determining whether an individual is marginalized or excluded from financial services. The main one, for most of us, whether we're sophisticated or not, is the lack of financial literacy and education. And the second one is the inability for individuals to develop a positive trade line or obtain credit. And these two factors in combination, keeps many Canadians, 12 million before COVID, that number is obviously slated to grow because of COVID, where we have a lot of people who, prior to COVID, may have been accepted by a bank, but given COVID situation, lending guidelines have changed, and those people who could have qualified for a mortgage or a loan, a car loan, home renovation loan, a credit card, a cell phone, or even insurance, they are now marginalized from being able to get those basic necessities for their normal course of living, as well as their long-term financial planning. So how does Marble do it? We're focused on the underbanked. We have multiple solutions. 3 of them are already in the market today, and 2 of them are on our roadmap, scheduled to be released in the first quarter and second quarter of 2021. I'll start with ScoreUp. ScoreUp is artificial intelligence. It's algorithmic mathematical-based software that focuses on the individual's credit profile. The software analyzes credit reports both from TransUnion or Equifax in Canada. In the U.S., there's also Experian. But it analyzes the credit report, and based on that credit report, not only does it give what the market and other players in the market are giving with respect to the credit score, but it does an analysis on the credit reports, and it gives specific recommendations. These recommendations are based on AI and thousands and thousands of credit reports already ingested into the system and millions of data points. So an individual could come into our software, credit report is pulled from either Equifax or TransUnion, and the software does an analysis on the credit report. Not only does it give a credit report, but it does an optimization. It'll tell that individual that, did you know that you have 30 points available? You could get 10 points if you pay X dollars to Walmart, 5 points if you pay Y dollars to Visa. And so the individual basically gets a roadmap and recommendation. And that's what differentiates us from the usual suspects in the industry that are just providing a credit score. This contributes obviously to financial literacy, because a lot of times individuals go into a financial institution looking for financing, and at that point in time they realize that they don't qualify. That credit score is the major determinant between an approval or decline. If the individual is approved, it's a major determinant on the terms that they get from the financial institution. So the concept around Score Up is very much know before you go, and the software provides prescriptive recommendations to the individuals based on how they can improve their credit score, as well as errors in their credit reports. A lot of times an individual is subject to errors and omissions on a credit report that is no fault of their own. And it could be because the creditor has not reported accurately or timely. And the software basically prescribes that information to the consumer. Fast Track is a lending product. It originates from the time that Marble was born in 2016. And at that time, that solution is focused on the segment of the population that is entered into an insolvency event. Over the last couple of decades, insolvencies in Canada have been increasing, and year over year, we've seen more and more people going into an insolvency. In Canada, there's two different types of insolvencies on the personal side. One is a straight-out bankruptcy, and the other one is what's called a consumer proposal. The consumer proposal is a process that is governed by the federal government with for-profit but regulated entities in the middle called licensed insolvency trustees. So an individual, when they determine that they're insolvent, they work with the trustee. They settle their debts legally through a court binding process where 35 cents, they settle for 35 cents on the dollar, and the remaining balance and the settled balance is then paid back to a trustee on a monthly basis, typically on average around 60 months. And every month that the consumer makes a payment, the trustee takes their portion of the fee, and the rest of the money is distributed on a pro rata basis to the creditors. Creditors love this product because it gives them an opportunity to recover their funds over time. But what happens is Marble originates these customers through our marketing efforts. We find these qualified applicants. We direct pay the trustee for those individuals that qualify, and the lenders, the creditors get their money paid up front, and the individuals are now dealing with Marble. Now, why is that important? Is because during the time the individual is paying this consumer proposal with the trustee, their credit is not rebuilding. Imagine paying $10,000 balance over the course of 60 months, and at the end of it, there's no benefit to your credit. Your credit has been damaged through the settlement process because of the consumer proposal insolvency process, and after 5 years, this individual has not seen any improvement. On top of that, after the 5 years, the record of the consumer proposal stays on the credit report. So this individual is in financial purgatory for up to 8 years, where they can't qualify for rent, they're declined jobs, cell phones, insurance, and any lending product, because 99.99% of lenders in Canada will decline an individual that has insolvency equals true on their credit reports. So when Marble finds these qualified applicants who are everyday people, we pay off the trustee. The consumer proposal is discharged over the next reporting cycle on the credit report. The consumer sees the credit score increase between 30 to 70 points after the next reporting cycle. And then with each future payment, Marble is reporting to the credit reporting agencies, and the consumer starts seeing credit rebuilding. And what we have found with our customers is that they're back into mainstream financial within a 4-year period versus an 8-year period. And so this is a credit acceleration program, which has been very beneficial to our consumers. And with the market opportunity over the course of the last few years, when insolvencies have been increasing, Right now, because the feds are subsidizing and created a soft landing for Canadian consumers, but as soon as that soft landing has been pulled, we anticipate a lot more consumers that have been going into the insolvency process. And prior to COVID, it was a $3 billion industry per year in Canada. Marble Maestro is already in the market, and it's our financial literacy and education product. Credit Beacon and Credit Meds are two different products. Credit Beacon is a secured credit card product that will be launched in the first half of 2021, and it's focused on helping individuals rebuild and rehabilitate their credit post-insolvency and for those individuals that have had damaged credit. Credit Med is a licensing product very similar to ScoreUp, which is a subscription-based software. And Credit Med is also a licensing model, but the focus is not the consumer. It's licensed insolvency trustees. Marble collects information on consumers. We package the information up. We collect information on the consumer, both with respect to their credit as well as their banking information. And the software itself will find a trustee near the individual that can help the individual go back and look at how they can settle their debts. So there's a lot of people online looking for loans, looking for credit, because that's all they know to ask for. But the bottom line is they're insolvent. They don't need a loan. They need credit relief. And they don't know how to ask for it, and our software will help marry that consumer with a licensed insolvency trustee that can help restructure their credit. So how does Marble do this? We operate in a world of everybody else's declines. A consumer is out there looking for credit. They're getting declined. They don't know how to improve their credit. A lot of them are insolvent. A lot of them just have poor or damaged credit. Because we operate in the world of everybody else's, all the other creditors' declines, we're very non-competitive from that standpoint. So we have a lot of referral partners that provide us leads for customers that they have not been able to monetize. Through our software and our creative solutions, we help these individuals back to recovery and through our multiple products. Many times the consumer comes in looking for a specific product. They come into the MyMarble platform, and the MyMarble platform gives them unique insights both on their budget as well as their credit. For every consumer that onboards, 9 out of 10 consumers, obviously we're getting consent from them on their credit, but we're also getting consent from them with respect to their banking transactions. So we have an aggregation of data for these consumers, both on the credit and the banking side, and it basically gives a holistic picture on the financial picture of these consumers. Through that, they get a lot of recommendations based on the credit as well as their financial picture, and that's what allows us to give them recommendations and insights with respect to their personal financial fitness. The platform is a subscription-based platform. There's a premium component, but if they do upgrade to a premium component, it is a SaaS-based situation, but there's a lot of add-on revenue depending on the consumer-specific situation, whether it would be a credit card, whether it would be a referral to another party, or whether it's a lending product through either us or one of our partners. So I talked about monetization. So an individual comes into the Marble ecosystem either through a direct B2C customer acquisition or through a B2B2C model where our partners are sending us consumers. These consumers come into our platform. They sign up, whether it's either premium or a subscription-based model, where they're being monetized on a monthly basis or on a pricing package based on what they choose. And through that, there's multiple different monetization efforts. In the industry today, there's already other players that are collecting credit data. And the way these companies monetize is they refer the customer over to other partners. Our model is unique. We're monetizing up front through our unique products, whether it's subscription-based or an add-on product. And at a point in time, once the consumer has been rehabilitated, we can provide referrals to other partners. Now, we can do that ourselves through our lending arm, depending on what consumer is looking for. But remember, as an example, the consumer once upon a time may have been declined by a mortgage. If they're declined by a mortgage, both the lender and the consumer has walked away with no deal. They come to Marble. Marble provides their secret sauce to that consumer is still looking for a mortgage. At that point in time, there's further monetization efforts for Marble, and the platform starts morphing into not just a B2C or a B2B2C platform, but a B2C2B platform. Because we're getting insights from the consumer on both credit and banking, we know how much a consumer is making, where they spend, how much they spend, who they're spending with. So we will know when the consumer, through our data science in the background, when the consumer is ready to make a purchase at Walmart, before Walmart knows and before the consumer knows itself. And at that point in time, our ecosystem will get larger with individuals that want to sell into our ecosystem and our platform. At this point in time, our customer acquisition, 70% of the acquisition is coming through Marble's own marketing and digital spend. 20% of it is coming through partner promotions and individuals, and another 13% is coming through website referrals. We're seeing a lot of flux in these numbers. At one point in time, a lot of the origination on the customer acquisition side was coming through partner campaigns. But as through our marketing efforts over the course of the last year, Marble has been very successful in creating relevancy in the market. Our solution actually completes the credit life cycle for individuals. A lot of lenders have been firing a lot of customers. The deferral programs have stopped. A lot of consumers are not being able to renew their mortgages. And so when they're online and through our partnerships, as well as the advertising that we've been doing on our marketing efforts, a lot of consumers are now finding Marble organically, and we're seeing a lot of growth in that area. In either case, this slide also speaks to us using best-of-breed technologies. Everything is predicated on the consumer's consent. They give us consent on their credit as well as their banking, and we collect the data, and through our best-of-breed partnerships, we protect the data, and the consumer is given access to the MyMarble platform. So what makes us very different is all our recommendations and insights are data-driven. I did say that we're a financial technology company with data science in the background, but everything that we are doing and recommending to the customer is based on real data. The customer does provide us information at the time of the subscription or the application, but everything is verified through real data, customers' existing spending habits, cash flow, income, as well as their behavior on their credit report. So every month on the software platform, a credit report is pulled for the consumer and new recommendations are given to the individual. Individuals see various degrees of a benefit from the platform. We've had people getting 100 to 200 points increase on the software within 1 to 2 months. And other consumers, it's a longer process. They got a roadmap with respect to how they're going to be able to achieve that financial future they're looking for, whether they want to buy a car or whether they want to buy a house. But based on monthly data and the individual's performance and behavior during that month, new recommendations are given the following month to the consumer. We do obviously provide a lending product that allows the individual to exit the insolvency event. But otherwise, our data is focused on a broad base on individuals, both down market as well as up market, because a lot of us have been in situations where we find out very late that there's an impact on our the credit report or score. But at the same time, these individuals are benefiting from financial literacy. It's a curated program where individuals sign up based on specific topics. They sign up and they complete quizzes, and they end up getting rewards based on, or a certificate based on completion of these programs. So our revenue model at this time is based on two major products that we have before the credit card and the credit meds is launched in Q1 and Q2 of this year. However, in the past, our subscription revenue and our loan revenue has been the major contributor to our revenue growth. On this slide, and we can talk about it during the Q&A, but I'll just go over it very quickly. Historically, Marble's in the past, the revenue growth has come from our lending products. We launched MyMarble and ScoreUp towards the end of last year, with further a relaunch with additional enhancements in earlier in 2020. And we're starting to see the subscription revenue grow. The unit economics on the loan products, because we're looking at ticket sizes of $8,000 to $10,000, the unit economics on a loan are considerably higher than what you would get on a subscription, but not all customers are insolvent. And I'm speaking to the originations of Marble. But most customers, all that we're dealing with, have improvements or optimization needs on their credit reports. And therefore, the software, you're going to see a lot more user growth with respect to the subscription side and complementary revenue growth with respect to the lending side. The blue bar here on this slide, apologies that the legend is missing here. The blue bars are revenue, and the orange bars are OPEX and corresponding growth where you'll see. So you're seeing OPEX grow in 2021 as we continue our growth and our acquisition model. A lot of our spend is going into marketing and technology. In 2022, you're seeing considerably more revenue growth, and that's complemented by the increase, obviously, on the lending side as well as the subscription growth. But OPEX is not growing at the same pace because of the automation that we're seeing. A lot of our OPEX costs are tied to variable costs associated with transaction pull, whether it's through our credit provider or through banking transactions, and so there's a correlation there. But you're starting to see us starting to develop efficiencies in 2022 as we complete some of our data science initiatives in 2021 and continue our growth from there. I'll go back into a little bit more on the strategy side. So when we're looking at our growth, historically Marble has been growing based on the fast-track products. There was obviously hiccups at the time of COVID because of lending guidelines being changed. A lot of lenders didn't understand or didn't know how their lending book was going to be impacted. We did do deferral programs with our lending business, but we found that we saw very little delinquency in our products on the lending side. We added other products such as ScoreUp in the MyMarble platform and Maestro, and that's speaking to Horizon 2. Horizon 3 is obviously our machine learning and data science. As more data is going into our software, it's going to allow us to continue to develop Marble scores, personal indexes. We want ultimately to make the competition irrelevant. We don't want to compete on the credit score. We don't want to compete on the lending side. We're about personal financial wellness and financial fitness. And on that, we're aggregating all this data on a segment of the market that everybody else is declining. And the data that we're accumulating is telling us a lot about this individual and how we can get them back to not just into mainstream banking, but into mainstream financial services and the mainstream economy. And so all these, although they're layered in Horizon 1, 2, and 3, all of this is happening at time equals 0, but it's layered on. The data is continuing to be accumulated and aggregated. So in terms of transformation growth, our early before COVID aspirations was get to 1 million users, looking to continue to develop our IP as well as augment our data infrastructure. The opportunity for us here, because we're operating in this, with the market that other people and other lenders and other providers are shunning, is there is an opportunity for us to be a next generation credit reporting bureau. We have information on consumers that are off the grid. This information we have with these consumers, the credit reporting agencies don't have it anymore because these individuals cannot get any credit. So with the alternative data sources we're using, including banking information, we're able to leverage and develop scores about individuals' ability. They're paying rent, they're paying their cell phone, they're paying their utility bills, and all this is aggregating into our data infrastructure and developing scoring mechanisms for these individuals and personal indexes. The next slide is just talking about what's happening in the market today. In October of last year, Forbes outlined the underbanked as the next $1 trillion opportunity in fintech. There was a few acquisitions or a few transactions in 2020, primarily Credit Karma acquiring Intuit, Visa acquiring Plaid, basically what you're seeing here is the big boys in the market are seeing the importance of aggregation of credit data and financial transaction data. There's a move towards obviously open banking, but at the same time, these entities and these transactions are speaking to transactions that are happening on the grid. But what about the individuals that are off the grid? And that's where Marvel's focus is. So we're the only company in Canada targeting this segment of the underbanked. On the lending side, we're the only company in Canada that is lending unsecured to these individuals across the country. We're focused on the 33% of Canadians pre-COVID that were marginalized, and we're continuing to see that grow. So we see that in the Canadian market alone, an opportunity of 28 million, and we believe that we are first movers in this industry, working with partners that can generate a lot of business and referral traffic for us as we continue to show our relevancy in the market. So with that, I'll stop there and see if there's a Q&A. So we do have some questions. Do we provide API integration into banking apps that currently show credit scores for free or at no premium? Great question. Some of the work that we did towards the end of last year and this year has been around this model. There is very much in our Marvel can go out there and generate these consumers ourselves. To generate 23 million users like Credit Karma is obviously going to be very expensive. However, our technology has got very much the Intel Inside approach. Our technology can either be embedded on our partners' platforms or through API integration. Our software has simulators in it as well. An individual can say, I want an 800 credit score, and our software will tell these consumer exactly what they need to do. Or the consumer, either through themselves or through our budgeting app and the insights that we get through their banking insights, we can find money for this consumer, and using our simulator, say you have $100, John, Mary, did you know that $100 can get you 40 points on your credit score? And this works on a month-to-month basis. We're able to find credit score improvements for these individuals every month based on specific recommendations. So yes, absolutely, that's part of the strategy. We have the ability to do an API into other people's platforms where it will be more My Marble inside. The reason why that's important is because Apple has taught us how user experience is very important. It's IP. A lot of entities that we have, whether they're mortgage brokers or other personal financial applications, don't necessarily want the consumer to leave their site and pass them over to another partner, and that's why the API was built in order to be able to allow partners to be able to continue to own their unique user experience. But in the background, Marvel is still generating the insights, and it's transaction revenue for us. The next question is, what was the loan loss metric in 2020? So our historically with Marvel, we've been generating revenue for a segment of the population that is traditionally being seen as subprime. Through our data, we have learned that these individuals are actually behave like near-prime customers. Our default is 7.25%, and these individuals, we're finding that 60% of these consumers pay us back within 36 to 40 months. And the reason they can do that is because we've been successful in the program. So imagine an individual that's gone out of that is in an insolvency event. They're unable to pay their creditors. They've gone into a collection cycle where they're getting nasty letters, phone calls, lawsuits, and they finally find themselves in front of a trustee, and they go into an insolvency. They go into the insolvency and they come out on the other end and into the brave new world and realize that life isn't that much better for them. Nobody wants to touch this individual because of the credit report. The credit report says they're in insolvency. They're highly motivated, high-intent individuals that only option for them for credit after an insolvency on an unsecured basis is either a high subprime auto loan or payday loans. And they've just already been through the process. So they fight very hard to not go backwards. Remember, they're being declined for insurance, for rent, for any forms of credit. So we find very highly motivated individuals. At the segment of the population that we're lending to, even though they're insolvent, we're still focused on the people that are A and B customers. We've stayed away traditionally from the C customers just because there's been a lot of instability in that application. So for the people that we've been lending to, our algorithm has been very successful, and we've historically we've seen that 7.25% defaults on these customers, and that is not what you typically see in a subprime space. So with that, I'm out of time. I was able to address the questions that came up. I thank you for your time and the audience there. My information is available. Look forward to those who do reach out. We weren't able to set up meetings for everybody just because of timing, but I want to give SNN thank you for giving us the opportunity to speak, and hopefully we get a chance to speak to members of the audience. Thanks very much, Keith.
And that will conclude the webcast. We thank you for your participation.